This is the last video in this series. This is video number 12. I have been attempting to finish this series for a few months, but things keep popping up. Life happens. I know I showed these images in another video. And I need to record newer images. Hell. I am old. So give me a break. Do you really want to see a 60-year-old man? No. I know you want to see hot girls in swimsuits. But I am old. So I do not know any. Compound interest. Before I talk about stocks and bonds, I first want to discuss compound interest. Many people do not know what this is or how it works. If you have an investment that provides compound interest, then it will grow quickly. However, if you have a loan where you are paying compound interest, then the amount you owe will grow quickly. They say that most investments do not provide compound interest. This is not entirely true. They also say that no one is stupid enough to get a loan where you are paying compound interest. Yet, here in the United States, millions of Americans do it every year. Which are car title loans, paycheck loans, and student loans. Plus, you can earn compound interest on a certificate of deposit. All you have to do is take all the money you earned on one certificate of deposit and buy another one. This is what I do, and the interest I earned is paying for half my plane ticket to go overseas. Brokerage firms such as Charles Schwab provides a higher rate of return on certificate of deposit compared to traditional banks. Almost double of what traditional banks provide. However, certificate of deposit is not 100% safe. They are one of the safest investment one can make. But they are not safe if you purchase one from China. My advice is to never purchase any investment or financial product or service that is connected to China. You might lose all of your money. And you also might owe money after all the fees are calculated. Plus, if you buy any financial product directly in China, you might not be able to get your money out of China. For example, Warren Buffett has over $40 million in China, and like many others, for over a year he has not been able to get any of his money out of China. He can still use his money to invest in China in any way he likes, but he cannot get his money out of China. Compound interest is where you earn interest on the interest. And your original investment is called principal. For example, you invest 100 and is earning 10% interest. Then, what is called simple or straight interest, you only earn interest on the 100. But with compound interest you earn money on the 100, and the 10% interest. For example, with simple interest, you invest 100 and gain 10% interest every year. Thus, the first year you made 10%, and the second year you made another 10%. For a total of 20% in interest earned. This time using the same investment but earning compound interest. You invest 100 and gain 10% interest every year. Thus, the first year you made 10%, and the second year you made another 10% on the 100. However, you also made 10% on the 10% you made in the first year. This gives you a total of 21% you earned in interest. With compound interest, after 8 years you would have made over 114 total in interest. Thus, the interest earned more than doubled your original investment. Where with simple interest you would have only made a total of 80. The examples I just mentioned were very simple examples. But loans are calculated differently. Here in the United States, if you have some kind of loan, let's say a 10-year loan, for the first 5 years, 70% of your monthly payments will mostly go towards the interest, and only about 30% will go towards the principal. For example, one woman had $92,000 in student loans. For 5 years she paid a total of $35,000. So she figured that she paid off almost half of her student loans. 92 minus or subtracting 35 equals 57. She found out that she still had about $74,000 left to pay on her student loans. In the 1970s and 1980s, one of the tricks people used to pay off their loan quickly was to send the bank 2 checks. One check would be for the monthly payment. And the other check would have written on it, in the memo section, that said for the principal only. Then according to the law, the bank would have to apply this amount towards the principal. This helped reduce the amount of interest the bank would be able to charge, and thus reducing the amount of time it would take to pay off the loan. If you did not write, only for the principal, the bank would apply this check toward the interest. Today, no one writes checks. Plus, if you did send a bank a check that said for principal only, people at most banks are so poorly trained that they would not know what to do. In the United States, student loans use compound interest. Back in the 1980s, the interest rate for student loans was between 8 and 10%. This is why today, there are over 2 million people over the age of 60 who are still paying off their student loans. President Obama did not pay off his student loans until after he became president. And yes, one can file bankruptcy on student loans. However, the requirements are so high that most will not qualify. In the United States, the best thing a person can do regarding their student loans is to apply for an income repayment plan. This is because, even if you never made one payment on your student loans, the government will pay off your student loans after 25 years. All of this information is on my other YouTube channel. But the channel is only in English. And is only for the United States. I will put a link to that channel in the description. Stocks and bonds. At one time this man, who is called Warren Buffett, was considered to be the richest man in the world. And probably still is. However, now the world is saying that this man, who is called Elon Musk, is the richest man in the world. But this might only be on paper. For example, this man, who is the rapper Kanye West, was said to be worth $1 billion. However, when he lost his Adidas contract, they said that he was no longer worth $1 billion. Thus, on paper he was worth $1 billion, but not in real life. So, a lot of the information you hear on television can be misleading. Warren Buffett became the richest man in the world because of his investment strategy. He never went for short-term gain, but always looked for long-term results. Which sounds great if you have the money. The problem with long-term results is that once that money is invested, you cannot touch or use that money for years. Warren Buffett's investment strategy is very simple. When everyone else is buying, is when you sell. When everyone else is selling, is when you buy. Many financial advisors will say that when the economy is bad is when you sell stocks and buy bonds. And when the economy is good is when you sell bonds and buy stocks. Warren Buffett did the opposite. When the economy is bad, companies sell less products and services, so their stock value drops. Which means that the price of their stock drops. Because of this, many want to get that stock out of their portfolio. Warren Buffett knew that if the company is a good stable company, in a stable market, then one day that stock will increase in value. This is because once the economy improves, people will start buying more products and services. Therefore, the company will sell more, which causes its profits to increase, resulting in the value of the stock increasing. Plus, it will be more valuable than it was in the past. So Warren Buffett would buy these stocks when the price of the stock reaches its lowest point. Then he would sit on the stock until the economy improves. When the economy improves, companies are now selling a lot more products and services. Thus, the value of the stock increases. When the value of the stock increases, then everyone wants to buy that stock. So that after a few months to a year, they can turn around and sell it at a profit. This is what many day traders do. Plus, most people only look at the value of a stock from year to year and never consider its value over time. Warren Buffett always considers the value of a stock over time, and when the stock reaches its highest price is when he sells the stock and purchases bonds. A bond is a loan that people provide to the government. Many companies also issue bonds, but when people talk about bonds, they are mostly talking about government bonds. There are all types of bonds, such as tax-exempt bonds, income-deferred bonds and many more. I will not talk about all the different types of bonds. That can be a video series in itself. When the economy is good, the government is collecting a lot more tax money. So they do not need the extra money to pay its bills. So the rate of return on these bonds is not very high. This is why many do not like buying bonds when the economy is strong. However, when the economy was bad, the government issued bonds with a high rate of return. And when the economy is good, people want to sell these bonds and get the money to purchase stocks. This is because people think they can make more money or get a bigger return with stocks than with bonds. When the economy is good, there are a lot of people that want to sell these bonds. Because of this, it can be difficult to find buyers. Because it is difficult to find buyers, Warren Buffett can now purchase these bonds at a discount. For example, if the bond has an interest rate of 7%, then he will buy the bond and provide an interest rate of 4%. Then when the economy is bad again, then he sells these bonds at an interest rate of 7%. Warren Buffett knows that the world's economy goes through cycles. The world's economy will be good for 3 to 8 years, then bad for 3 to 8 years. This cycle will keep repeating. The other thing he does is not to always buy stocks of major corporations. If a company such as Apple or Starbucks gets a new supplier, then this is the stock you want to buy. The supplier stocks. These stocks have the most growth potential, which means they will increase in value the most. This is because, over the years, Apple or Starbucks, depending on the new supplier's performance over time, will provide them with more and more business. Plus, once this new supplier has proven itself, then Apple or Starbucks competitors, in addition to various governments, might also provide these companies with business. Thus, the supplier's growth is not only connected to Apple or Starbucks growth. The problem is finding out who their suppliers are, or who might become a supplier. In the 1980s, to become a day trader, one had to buy a seat on one of the exchanges, such as the New York Stock Exchange. I know back then, in Chicago, this cost $60,000. I met a man who purchased a seat on the Chicago Mercantile Exchange and lost it all within 6 months. Today, to become a day trader, you only need a computer and an internet connection. Some people make a very good living being a day trader, but many go broke or lose all their money. You never hear about the people who lost it all or are struggling. You only hear about the winners. Most day traders' method is to make money from a stock within a few months to a year. They need the money to live on and pay bills. Investment banks look for longer-term results. In my video number 6, which is called Options Trading and Stockbrokers, What to Watch Out For, I explained how investment banks get rid of their bad stocks. They get rid of their bad stocks by selling them to the little person. You know, the grandmother or even you. The people who know very little on what is going on in the market. About 20 years ago, my aunt lost almost half her savings listening to her stockbroker. Lucky I moved in, or she would have been struggling. But now, since President Biden increased Social Security payments, so she will be okay. I was not around when she did this, and this is why I did not advise her on what to do. I only found out afterwards. Because of this, they like to tell you about all the winners. The more winners, the more people think they can do the same thing, or at the very least, not lose a lot of money trying. And the more people who try and are not professionally trained. Which means that the more money Wall Street and investment banks earn.